So on 17th of Feb, we will solve the Kingtim company question, which has been tested in September, December 2020 attempt. Basically, this question is all about the cost of capital. The question related to this area has been tested in past exam papers many times. For example, the question related to this area is Murada company, TISA company, Coiden company. Many questions in past exam paper has been tested like this. So let's start with the question. Let's read the requirement first. Discuss the feasibility and effectiveness of the defense strategies of selling off individual garden centers and enhancing directors' remuneration. Maybe you have heard that in business valuation, in merger and acquisition, there is a topic that is defenses, the defense mechanism to save your company from the hostile takeover. So here in this scenario, examiner has discussed two types of defenses. First one is relevant to the crown jewel defense, and second one is more relevant to the golden parachute. So we will discuss after reading the scenario. Second one, prepare a report for the board of directors of Kingtim company, which first one, estimate the company's cost of capital before the new bond are issued. So you need to calculate current cost of capital. You need to calculate current WACC. That is a 4 marks. And that is very simple part. Very simple part. Beta is given, KD is given. You just have to calculate the WACC. Second, estimate the market value and yield to maturity of the new bond. This part is important. This part is relevant to the bond yield topic. Bond yield topic. And this topic has also been tested many times in past exam paper. Third part, estimate the revised cost of equity, the new cost of equity, and the revised cost of capital if the new bonds are issued. So in this question, company is issuing a new bond, and using the proceeds of that bond, company is investing in a new business. And obviously, if the business is changing, that means beta will also change. So you need to calculate the new cost of equity as well as the new WACC. Okay, in fourth part, estimate the impact of the CEO proposal on the forecast after tax earning for the coming year. You need to recalculate the earnings. Fifth part, discuss the impact on the Kingtim company cost of capital and the reaction of equity and bondholders to the CEO proposal. So currently we don't know what is the CEO proposal, but what is the impact on the cost of capital? Obviously, you will compare the current cost of capital and the new cost of capital. If the cost of capital is increasing or if the cost of capital is decreasing, you will comment according to that situation. Okay, this discussion should also include an explanation of any assumption made in the estimates in part B to B4. Professional marks will be awarded in the part B of the format, structure, and presentation of the report. Obviously, you will leave few pages initially for the report, and you will solve all the calculation in the appendix. In part C, discuss the approach taken to the employee remuneration by Kingtim company, Northern region, and the issues associated with it. 8 marks. Okay, let's discuss the scenario. Kingtim company is a nationwide chain of garden centers selling products such as plants, fertilizers, tools, and garden furniture. It was established 20 years ago by the current team of executive directors and achieved a listing on its local stock market 4 years ago. Since listing, the company has made consistent profit and has been able to increase its dividend each year. The executive directors collectively own between them 25% of the issued share capital. So that means directors own 25% of the company. The remaining shares are held by the number of investors, with none of them owning more than 10% of the issued share capital. Two of the Kingdom company major competitors have been taken over in the last 2 years. Media coverage suggests that further takeovers are possible. That means you will become the next potential target. Potential acquirers include other chains of garden centers, property developers, and supermarket chains looking to diversify their business into the profitable garden center. Obviously, your company is profitable, so you will be one of the target for the acquisition. As yet, no potential acquirer has approached Kingdom Company to buy the whole chain, although Kingdom Company has had inquiries from other businesses wanting to purchase individual garden centers. Kingdom Company can sell a number of individual garden centers without threatening its continued existence. So there can be a threat that some company will acquire the whole Kingdom Company. But currently you have the choices to sell individual garden centers to the potential buyers. So these are the takeover defenses. Kingdom Company's executive directors remain committed to the business. They are fearful of a takeover. Obviously, if you are the director of a Kingdom Company and somebody is acquiring your company, obviously you will be fearful. Fearful for what? Fearful for the shareholders? No, fearful for your own job. Obviously, if you are the director of any company, you are enjoying the perks and benefits and the lavish salary. If someone acquire your company, obviously he will fire you and you will be having nothing. So that's why you are fearful. They are fearful of a takeover, believing that the new owner will want some or all of them to leave the company. They have therefore been considering possible defenses against a takeover bid. Kingdom Company CEO has received 2 proposals from the directors. First one, sell individual garden centers, which would be particularly attractive to the purchaser. Disposal of these centers would make Kingdom Company overall a less attractive purchase. So you have to discuss on this. This is more like a crown jewel defense. Sell the individual garden centers, sell the few lucrative, most profitable individual garden centers. What will happen? Now you will have less number of profitable garden centers. Your company will become less attractive and nobody will be interested in buying you. But listen, if we have sold the profitable center, what will happen to your other shareholders? Your other shareholders are attached with you because of those profitable centers, and if you sell all those profitable centers, it will be a setback for the other shareholders. And plus, let's suppose if you sell the profitable gardens, now your company will be full of or rich of cash. If your company is rich of cash, you are again a potential target. Again, your position is very attractive for other acquirers. And let's suppose if you pay back all the cash, all the available cash as a dividend to the shareholders, what will happen? Now your company will become smaller and it will be easy for buyers to acquire your company because now your company has become a smaller company. So you have to discuss the pros and cons. So what is the pro for this? That your attraction has become lower. Now acquirer will not acquire your company. But what are the cons for this? If you sold the company, if you are selling the company, then you will be rich of cash. Again, you will become attraction for the acquisition. And if you distribute the cash, your company size will be lower, and you can easily be taken over by some company. And third, if you have sold the profitable centers, that means it will be difficult for the existing shareholders to stay with you because now your company is less profitable company. No, Bilal is asking, should we discuss that garden should be sold and leased back? No, Bilal, we have to discuss only on these 2 scenarios. We can't propose a new one. You can write in a simple line, but you should not insist that your recommendation is better compared to these. You can discuss, but mainly you have to discuss on these two. Okay, the second one, pay the executive directors a higher remuneration and change their contract so that they would receive much higher compensation for the loss of office if their contracts were terminated early. Obviously, what is the pro for this? Directors have become more expensive. If let's suppose if I acquire your company, I have to give higher amount or higher compensation to fire the directors. So it will be difficult for me to bear such a huge cost. So that's why I will not acquire your company. This is the pro. This is the benefit of this defense. What is the cost of this defense? You are increasing your cost. You are increasing your company's cost. Now director will get higher remuneration. This will haunt the company profitability in future. Okay, next is Kingtim Company CEO believes, however, that any defense Kingtim Company adopts should also strengthen the company future. She is therefore proposing to expand the company current limited sales of camping products in its garden centers by establishing a chain of Kingtim outdoor shops selling camping, walking, and other outdoor equipment. The outdoor retail sector is competitive, but the CEO believes that Kingtim Company will be successful. The establishment of the chain of outdoor shop would be funded solely by the debt, and the idea being that changing Kingtim Company finance structure by having significantly more debt would make it less attractive to acquire it. This is another defense. And what is that? That arrange maximum financing from the debt. And if you are able to arrange maximum financing from the debt, your gearing, your financial risk will be higher and your company will become risky for acquisition. But what will happen? It will increase the financial risk. It will increase the future finance cost of the company. And let's suppose if interest rate increases, it will have a negative impact on the company. And maybe your current shareholder will not accept this. Maybe your other current shareholders will not accept this proposal because your company is becoming more risky. So guys, remember one thing. Whenever you are reading a scenario, discuss all the possible pros and cons or the possible solution of every problem. Try to discuss. And then again, read the requirement. You will easily find all the points and you can easily answer those points. Now, firstly, we have read the requirement, and that is discuss the feasibility and effectiveness of the defense strategies of selling off individual garden centers, enhancing director remuneration. And when we were reading this requirement, we didn't know anything about the scenario. Now, after reading the scenario, we can easily answer these defenses approaches, or we can easily answer the first requirement. So whenever you are reading the scenario, try to write somewhere like here on the question paper, or while doing in exam or while doing the practice, try to discuss in your mind or with some friend that what are the pros and cons of these issues. Okay, but if debt increases, WACC decreases. Yes, you are absolutely right. It depends. If debt increases, obviously WACC will decrease, but it depends. You remember that if debt increases, financial risk will also increase, right? And if financial risk increases, cost of equity will increase. So it depends, and we have to calculate this. And after calculation, we will discuss that whether WACC is increasing or decreasing. Okay, Kingtim Company currently has 25 million shares in issue with a current share price is 5.56. It also has a 0.45 million 6.5% bond in issue. Each 6.5% bond is a nominal value of $100 and is currently trading at $104 per $100. The premium on the redemption of the bond in 3 years time is 2%. Based on the YTM approach, the after-tax KD is 4.1%. So examiner is very kind. KD is given, share price is given, bond price is given, and beta is given. Kingdom Company quoted equity beta for its existing garden center is 0.9. So current, you can easily calculate the current WACC. Okay, next is Kingdom Company plans to issue 0.6 million, 7.5% new bond, each with a nominal value of 100. These bonds will be redeemable in 4 years time at a premium of 8%. This is a new bond. And remember, while doing preparation or while doing studying the individual topics, there was a topic named bond yield and bond valuation, in which you have already studied that there can be a problem in exam that you want to calculate the market value of a new bond. And in order to calculate market value of a new bond, you have to discount the interest and the redemption value using spot yield plus the spread. Remember, there was a topic named bond yield, and you have to take the present value of future interest and redemption using the spot yield and the spread. So this topic has been tested here. Kingdom Company plan to issue 0.6 million, 7.5% bond. Coupon is given. Nominal value is given. Bond will be redeemable at 8% premium. That means bond will be redeemable at 108. Coupon on these bond will be payable on annual basis. Rating is BBB. The issue of the 7.5% bond will not affect the market value of the shares or the existing bond. This is a challenging one. By issuing new bond, there will be no impact on the market value of a share. This is an assumption, and this is a challenging assumption, because practically when financial risk increases, cost of equity will also increase. Try to focus on the words. If cost of equity increases, market value of shares will decrease. But here we are assuming that market value will remain same. This is an assumption. You have to write this. The market value of the new bond will be determined by using information relating to the Kingdom Company credit rating, the 4 bonds which the government has issued to estimate Kingdom Company yield curve. And remember, the yield of the government bond is called spot yield. Okay. I said that there is a statement here that issue of the new bond, that by issuing new bond, there will be no impact on the market value of a shares or the previous bond. This is not true 100%. Why? If we issue a new bond, if we raise new bond, what will happen? It will increase the financial risk. And if financial risk increases, that means beta or cost of equity will increase. And if cost of equity is increasing, that means market value of a share will reduce. But here we are assuming that it will remain same. I'm not challenging this assumption. I'm saying that you should write this assumption in that part where examiner has asked you to state the assumptions. Okay, these are spot yield. Spot yields are given. Year 1 spot yield is, year 2 spot yield, year 3 spot yield, year 4 spot yield, and BBB spread is given. You will add this spread to the year 1 spot yield. You will add this spread to the year 2 spot yield. You will add this spread to the year 3 spot yield, and year 4 spread to the year 4 spot yield. And you will discount the future interest and the redemption value of the bond to calculate market value. Okay, we will solve this later on. Kingdom Company plans to invest 60 million in the non-current asset of the outdoor shop. Outdoor shop is a new business. It is a new business. Outdoor shop is a new business. Working capital requirements can be ignored. So Kingdom company plans to invest 60 million in the new business. Currently, Kingdom company non-current assets have a net book value of 150 million. So the existing business assets are 150 million. New business has assets of 60 million. It is assumed that proportion of the book value of the non-current asset which will be invested in the outdoor shop and the garden center will give a fair representation of the size of the each business with the Kingdom company. This line is very, very important. Please read this line again. So that means 60 million represent the new business and 150 million represent the old business. So why these proportions are given? For the weighted average of the beta. The asset beta of the similar company in the outdoor retail sector is assumed to be the 0.88. So 0.88 is the outdoor shop beta. And for the existing business, obviously this beta is given. Obviously, we will take the beta asset. Before taking into consideration the impact of this investment, Kingdom company forecast pre-tax earning for the coming year is 24 million. So 24 million is your forecasted earning, but before the new business. It is estimated that new investment will make 10% pre-tax return. Corporate tax rate applicable to all companies 25%. Current risk-free rate is 4%. The market risk premium is 9%. Okay. Any issue till now? So by the way, previously you are earning 24 million, right? On the investment of 150 million. Previously you are earning 24 million on the investment of 150 million. So how much in terms of percentage you are earning? Please calculate. 16%. And on the new investment, you are earning how much? 10%. So this is a point of discussion that previously you are earning 16% on the investments, but now you are earning 10% on the investment. Then why are you accepting or why are you investing in the new project? Although new project is generating return, but new project is generating far less return compared to your existing return of 16%. So I am putting a question mark here. Okay, let's move to the last, employee remuneration. Kingdom company annual report contains a general commitment to act with social responsibility in line with society expectation. So it is stated in your annual report that you are committed to the social responsibility in line with society expectation. If society is expecting something from you, you are committing, you have the commitment to deliver that. It also commit to paying its staff fairly in accordance with their responsibilities and states that its staffs are vital to its success. Obviously, what is the meaning of this statement? That means who are more responsible, he will be paid more. Who are less responsible, he will be paid less. Obviously, this is a common sense statement. security guard or office boys or the sweepers will be paid less, but who is more involved in the decision making, who is more involved in getting the business, who is more involved in generating the business will be paid more. And states that its staffs are vital to its success. And this is a general statement for all the staff. To try to improve the situation of low paid employees, the government has recommended a basic hourly wage as the minimum level employees should be paid. So government has stated that all the companies should pay this minimum wage on per hour basis. Although this minimum is not legally enforceable. Government is encouraging to pay that minimum or basic hourly wage, but this is not legally enforceable. Although it is not legally enforceable, but society, it is accepted. I'm saying it in a general way that it will be a society acceptable. It is according to the society expectation that every company should pay minimum wage rate. So a newspaper investigation has revealed that some staff in the Kingdom Company Garden Center in the northern region of the country are paid up to 15% less per hour than the recommended minimum wage. Most of these staffs are part-time staff working limited hours each week. The manager of the Kingdom Company Northern Region Center, when asked to comment, stated that Kingdom Company had obligation to its shareholder to control staff cost. Okay. Lower pay level were necessary to differentiate between staff, ensuring that manager and staff with experience and the expertise were appropriately rewarded. Okay, point number 2, the manager commented that the pay levels are reflected the lower commitment of the Kingdom Company which part-time staff made compared with the full-time staff. So there are 3 points here and we have to discuss in the last part. Discuss the approach taken to the employee remuneration. What is the approach? And then the issues associated with. So approach is very simple. Approach is company is insisting that company has differentiated the responsible and the less responsible employees. So according to the company, the full-time employees are more responsible, so they are rewarded well. And company has tried to differentiate between full-time staff and the part-time staff. So according to the company, full-time staffs are more responsible and part-time staffs are less responsible. So that's why full-time staffs are paid at a higher rate and part-time staffs are paid at lower rate. Okay. And second one, company has done this just to reduce the cost because they want to generate profit for the shareholders. That was the approach. And what is the issue associated with it? Although employees are part-time employees, but let's say instead of giving 8 hours to the company, if they are giving 4 hours to the company, they are equally responsible for that 4 hours. Obviously, they are doing their work with devotion in those 4 hours. So it is totally unfair to state that you are part-time employees, so that's why you are less responsible or you are not doing your work with devotion. So it is unfair on the company's part. So that is the major issue associated with it. And this is an ethical issue that you are differentiated, you are creating discrimination among the employees. Okay. And there is another problem. In first 2 paragraph, company's directors were insisting that their pay level should increase to create the defense. And here you are saying that you are paying 15% less amount from the minimum wage rate. This is another ethical issue. The directors are getting higher pays and but your other staffs are not even receiving the minimum wage. So what will happen? Obviously, your part-time employees can leave the company and it will be difficult for you to fulfill the gap which will created after they leave the company. So that can be the problem. So you have to discuss this. Firstly you have to discuss what is the approach taken to the employee, what is the approach, and then what are the issues associated with it. Okay, next is let's do the numerical part, then we will read the examiner answer. Obviously, estimate the company current cost of capital before the new bond issue. This is very simple. This is very simple. Current beta is given, risk-free rate is given, equity risk premium is given. This is equity risk premium is given, market risk premium is given. Current KD is given, shares are given, market value is given, bond number of bonds are given, and its market value is given. So let's calculate the current WACC. Okay, I am solving this question on the manually, but you can also solve this on the computer if you are appearing for the CB exam. Obviously, it is not difficult to calculate cost of capital or cost of equity on the computer. It's very easy. So let's calculate the cost of equity first. Current WACC, current cost of capital. Okay, what was the risk-free rate? 4% plus beta was 9, and what was the risk premium? 9%. So what is the cost of equity? 12.1%. KD was given, KD was 4.1%. Equity value is 25 million shares into 5.56. 5.56? 5.56, yes. So it will be 139 million. And number of bonds are 0.45 into market value bond was 104. So 48.6. So everything was very straightforward. Calculate back. 12.1 into what is the total of these two? $185.8. 9% is given here. Market risk premium. 9%. $48.6, no? 46.8, sorry. Okay. So this total is okay. 185.8. What is the WACC? What is the current WACC? 10.1. Perfect. So current cost of capital was very easy. I think this part contains 4 marks. Okay, let's move to the second part. Estimate the market value and yield to maturity of the new bond. 7 marks. First of all, you will calculate the market value, then you will calculate the new bond. Okay, let's move to the scenario again. New bond has interest rate of 7.5%. 4-year maturity. And at the end of 4th year, bond will be redeemable at 8% premium. So what will be happen here? So let's calculate market value of new bond. Part B, write years 1, 2, 3, and 4. Cash flows. Obviously, you will receive 7.5 interest every year. 7.5, 7.5, and in fourth year, you will receive two amounts, 7.5 plus 108. 7.5 interest plus 108. Why 108? Because bond is redeemable at 8% premium. Bond is redeemable at 8% premium. It is clearly stated here that bond will be redeemable at 8% premium. So that means instead of 100, you will be receiving 108 plus 7.5 interest. Okay. You will discount year 1 cash flow Shoaib is asking that which method you are using for valuation. I'm using spot yield plus spread to discount the future cash flows. Topic name is bond yield and bond valuation. This topic is normally covered at the end of the session. Okay, first discount rate will be 4% plus 0.56. Second discount rate will be 4.3 plus 0.78. So first discount rate is 4.56%. Discount factor, spot yield plus spread. Will these lectures be available? Which lectures? The one which I am conducting? So first discount rate will be 1.456 raised to power minus 1. And second year discount factor will be second spot yield and the spread. Please add 4.3 plus 0.78. 4.3 plus 0.78. 4.3 plus 0.78. 1.0508. Okay, third one will be 4.7 is the spot yield plus 106. 4.7 plus 1.06. 5.76. Normally. No, here's a normally. And 5.2 plus 1.35. 5.2 plus 1.35. This will be 6.55. 1.0655 minus 4. Please calculate the present value of all cash flows. First one will be 7.173. Second one is 6.792. Third one will be 6.34. Fourth one will be 115.5, right? 89.61. One market value is 109.92. This is the correct answer, 109.92. Obviously, any answer near to this will be correct. So now market value is available, coupon is available, redemption value and number of years are available, you can calculate the YTM. Calculate YTM. This is the market value. Yes. If you want to calculate the total market value, we need to multiply with 0.6 million bonds. But obviously, in order to calculate YTM, there is no need to calculate total market value. So calculate first discounting at 5%. Positive answer. And then take the 10%. $23.77. Please calculate IRR. Let me recalculate. Oh yes, this is 0.8227. $3.546, right? It is 6.59. 88.85. 5.52. Please check. $6.54. Please confirm. 6.54 is the YTM. Obviously, if you are using Excel, you can easily calculate the figure. And obviously, your answer can be different from my answer, because in Excel you have calculated the precise answer, and I have calculated the approximate answer. There can be difference. So no issue. Anything near to 6.5 is correct. Jawad, examiner has asked to calculate YTM. We will apply tax in next part. In next part. Okay, let's move to next part, that is calculate revised cost of equity. Now, what is happening? You are investing in a new business and that new business beta is 0.88. So what we have to do, we have to calculate the new beta asset. First of all, we will calculate the previous beta asset. Then we will use the previous beta asset plus this beta asset to calculate the weighted average beta asset. And then we will re-gear that beta asset to calculate the beta equity. And we will put that beta equity into the CAPM to calculate cost of equity. And then we will calculate the WACC. So first of all, for the next part, part B, third part. First of all, calculate the existing beta asset. Calculate current beta asset. Beta asset is equal to beta equity was 0.9, remember? And the previous equity, you have already calculated the previous equity. I think 139. 139 plus 46.8. 139 plus 46.8. What is the tax rate? Tax rate was given. What was the tax rate? 25%. 25%. .75. So what is the beta asset, guys? .7, approximately 0.72. It is exactly 0.7185. And new business beta asset is 0.88. Now calculate weighted average beta asset. Old beta asset is 0.7185 and old business proportion is 150. New business beta asset is 0.88 and new business proportion is 60 million. Total is 210. So calculate the weighted average beta asset. It is 0.77. Okay, perfect. Re-gear this beta asset using new gearing. Obviously now gearing or debt equity structure has been changed. There is a question that why we are calculating the weighted average. In this question, it is stated that you are investing in a new business. I think new business name was outdoor shops. You are investing in a new business. Your previous business beta is different. Your new business beta is different. So in order to calculate the new WACC, you have to calculate the average beta asset. Okay. Okay. What is the new gearing? First of all, calculate the equity. And it was stated in the question that equity will remain same, 139 million. And the previous debt value will remain same, that is 46.8. And the new debt. New debt market value was 109.92. And the number of new bonds were stated how much? 0.6 million. Here it is stated here in the first page, 0.6 million. So calculate the market value of the new bond, total market value of the new bond, 65.95. So what is the total market value of all these three? 251.75. So let's re-gear the beta asset. 0.77 is equal to beta equity into equity value is 139 divided by 139 plus the sum of two debt is 46.8 plus 65.95 into 0.75. So go listen. Firstly, we will calculate the ungear beta of our old business. I think you were clear on that point, right? On this point. Okay. Now you are investing in a new business and new business asset beta is 0.88. Old business asset beta is 0.7185. New business beta asset is 0.88. And proportion of the businesses are given. New business asset is 60 million. Old business asset is 150 million. Using the given proportion, calculate the weighted average beta asset. So weighted average beta asset is 0.77, right? Clear? Perfect. Now calculate the market values of equity and debt, the market values of new equity and debt. And it was stated in the question that equity value will remain same and the old debt market value will also remain same. And what about the new debt? Number of bonds of new debt is given. And we have already calculated market value per new bond. Multiply these two. Market value of the new bond is 65.95 million. Now, using the beta formula, put all the relevant data and calculate beta equity. Please calculate beta equity. And there is a question asked by FH. And that is, for new debt, why can't we do 109.92 into 108? What is 108? 108 is not the number of bonds or market value. 108 is the redemption value. Remember total market value. How to calculate total market value? Number of bonds into market value per bond. Simple. Okay. Perfect. What is the beta equity, guys? 1.24. Is it correct? Okay, now calculate cost of equity. 4% plus 1.24 into 9%. 15.16. Okay, what is the old KD? 4.1%. And what is the new KD? We do not have new KD, but we do have new YTM. 6.54. And remember, what is the difference between YTN and KD? Tax. So we can, although it's bit wrong, but we can directly calculate its after tax value. What is its approximate after tax value? 4.9. 4.9. This is assumed KD. This is not 100% correct KD. Guys, this is not 100% correct KD. This is an assumed figure. Sir, now your question will be, what is the correct way to calculate KD? You have to resolve this whole pro forma by putting after tax interest here. Remember, we used to calculate KD using IRR method. Remember, guys, what we have to do? We have to put after tax interest in this pro forma to calculate KD. But obviously, it will become time consuming for you. So that's why, yes. Obviously, we will do 7.5 into 0.75. And then we will again calculate this YTM or again calculate this IRR. And then this IRR will be equal to KD. That is a correct approach. But obviously, if in exam there is a shortage of time, assume that 6.54% is the YTM. Assume that directly by taking directly gets after tax value, this is the KD. But obviously, this is an assumed figure. You should keep this into your mind that this is not exactly or precise or correct answer. This is an assumed figure. Examiner will give you full marks if you write the assumption. But you should know what is the correct way to calculate KD. And what is the correct way to calculate KD? You will calculate KD using IRR by putting the interest as after tax value. Okay, guys, are you getting this point, right? Khizr? In order to save the time, I am taking its after tax value. I am assuming that this is KD. But this is not the precise answer. What is the precise way to calculate KD? You should apply this pro forma and calculate IRR to calculate KD by putting this interest as after tax figure. That is the correct way to calculate KD. But obviously in exam, if you are short of time, you can calculate, you can directly calculate this figure. Jawad is asking that no, Jawad, you can't calculate WACC without taking its after tax value. You have to do the after tax. So FH has, FH, you have applied this full performer? Okay, that means the correct answer, the precise answer, I'm using the wrong word actually. The precise answer is 4.7, but the approximate answer is 4.9. So that is perfect. No issue. So okay, guys, now calculate WACC. 15.16 into 139 divided by 251.75. Okay, old KD, 4.1% into 46.8 divided by 251.75 plus 4.9 into 65.95 divided by 251.75. So what is the new WACC? Please calculate. %10.42%. $10.42. Perfect. Okay, guys. Now let's calculate. Okay, there was one more point. So can we calculate first weighted average KD? Yes, you can calculate Khizr, but obviously you will lose the time. That's the issue. Otherwise, there is no problem in it. Okay, now we are calculating the forecast after tax earning. Forecast earning. Okay, current earnings are forecast earnings are 24 million, right? So let's take let's round off 000. Current forecast earning is 24,000. This is pre-tax or post-tax? Pre-tax. It's pre-tax. Current earnings pre-tax. Okay. What about the additional earnings? Obviously, you are investing in a new project and additional earnings are on 60 million project, you will earn 10%. On 60 million project, you will earn 10%. So what is the 10% of 60 million? 60 million is the new assets of new business. 60 million is the assets of new business. And you are earning 10% on it. So what will you earn? 6 million, right? 6 million means 6,000. Okay, what is the increase in finance cost? Increase in finance cost because increase in finance cost. Obviously, you are taking new loan and on the new loan, you will have to pay new interest. So you have taken loan of 60 million and you are paying interest of 7.5% on it. Please calculate 60 million into 0.075 and it is 4,500. This is the finance cost. Total pre-tax earnings, and it is 25,500. Post-tax earnings, deduct tax of it, tax from here, 19,125. So what is the current post-tax earning? Current post-tax earnings, 24,000 into 0.75, 18,000. So what is the, how much there is an increase in earning? Double 125,000. Look, this is the current forecast earning. Obviously, this is pre-tax earning, 24,000. Additional earning, if you invest in a new project, you will get a return of 10% on the investment. Pre-tax. All earnings are pre-tax. So you will earn 6,000. Previously, you were earning 24,000. But in order to earn 6,000, you have taken a new loan at 7.5%. New loan is at 7.5%. So you are paying interest of 4,500. This is an additional interest compared to the previous one. So total pre-tax earning is 25,500. And if we calculate the post-tax earning, it is 19,125. And what is the current post-tax earning? Current pre-tax earning was 24,000 and current post-tax earning is 18,000. FH, this includes the new project. And this current post-tax earning is without new project. That's the difference. Okay. Okay. Instead of doing all this calculation, you can simply calculate increase in earnings. Instead of doing all these calculations, you can simply calculate increase in earning. And what is that? You're doing a project of 60 million. And on that project, you are earning 10%. How much? 6,000. And on that project, you are paying interest at 7.5%. How much? 4,500. So what is the earnings? 1,500. What is the increase in post-tax earning? Calculate its after-tax value. 1125. Instead of all these calculation, you can simply calculate this. Please have a look on both of these solutions. Any issue, guys? Calculation part is okay. Okay, this is the solution of the question. This is the theoretical part. Please read the theoretical part. And question is very simple now. Okay, what examiner has done, examiner has directly calculated in YTM, in calculating the YTM bond, in examiner has taken the after tax interest value. Remember, in my solution, I have taken the before tax interest here. So this is my contradiction with the examiner solution, but I am standing firm on my solution, and that is, in order to calculate, whenever there is a requirement to calculate YTM, you should never deduct tax. So this is I think, in my opinion, this is wrong. And now your question should be that why examiner has taken the post interest value here? Just to save time in WACC calculation. So our solution is little different here. Whenever there is a requirement to calculate YTM, you should never deduct tax. Okay. And when you want to calculate WACC, here you should deduct the tax. That's the difference only. Okay. So first part, examiner has done the discussion on the sale of garden centers. This is a discussion on the first defense. This is a discussion on the second defense. Then in report, examiner has briefly explained the introduction. Then the discussion on the cost of capital, on the assumption, and on the equity holders and bond holders point of view. No, you should not write any assumption about the YTM, because whenever there is a requirement to calculate YTM, you should always use the before tax figures. Okay, there is a question that what is the format of the report? This is the format of report, Shweb. You have to write the introduction, then briefly explain your answer. And how you will explain here? Look, there is a requirement in the question. This is the requirement. Read this requirement. Discuss the impact on the Kingtim company cost of capital. So first heading is of cost of capital. Remember, the current cost of capital is 10.1%. And remember, the new cost of capital is 10.42%. You will write that why cost of capital is increasing despite the fact we are increasing the level of loan. Why cost of capital is increasing? You have to write the reason. And the number one reason is, previously cost of equity was 12.1%. And now cost of equity is 15.16%. Cost of equity is increasing because of two reasons. One, business risk is increasing. Even beta asset is increasing. Previously, beta asset was 0.7185. Now combined beta asset is 0.77. So the number one reason is business risk is increasing. Second reason is gearing, or the financial risk, is increasing. So that's why overall cost of equity has been increased. And because of the increase in cost of equity, WACC has been increased from 10.1 to 10.4%. Although in start of the question, we were discussing that if there is an increase in debt, WACC should reduce. according to the theory. But here WACC is increasing because of the business risk and the financial risk. Both are increasing, and because of the increase in cost of equity, WACC has been increased overall. So while writing the report, your first heading should be of the cost of capital. And then your second heading should be of the reaction of equity holder and the bond holder, and plus the assumptions. Explanation of any assumption. Financial risk and business risk do not always move in the same direction. Only in this question, they are moving in the same direction. Okay. So guys, in your report, your first heading should be of the cost of capital. Second heading should be of the reaction of the equity holder and the reaction of the bond holder. And the last heading should be of the assumption and the conclusion. So you can see the report. First heading is introduction, cost of capital, assumptions, equity holder, bond holder, and conclusion. So report is only of the fourth part. Fourth or fifth. Report is only of the fifth part. But in report, you have to discuss all the previous four parts. Report is only for the fifth part. But obviously in fifth part, when you are writing a report, you have to discuss all these four parts. Okay. Now let's read the solution. First is the introduction, then cost of capital. There are two impacts in opposite direction. On the weighted average cost of capital, Kingtim company cost of equity has risen significantly. This is due to increased business risk resulting from the investment in the outdoor shop and increased financial risk from the additional debt. The increase in cost of equity has pushed the weighted average cost of capital upward. However, the higher proportion of debt in the company finance structure, with debt having a lower cost than the equity and also being tax deductible, has pushed the weighted average cost of capital downward. Obviously, cost of equity is expensing. So the cost of equity is pushing the WACC upward, and KD is cheaper. KD is pushing the WACC downward. But overall, WACC has increased because cost of equity has major proportion. Then what are the assumptions? The assumption about the return from the new investment may depend on how much Kingtim company can attract customer away from the competitors. Obviously, it is written here that you will earn 10% on the new project. But obviously that 10% depends upon that you will earn the confidence of the customers. Then kappa model used is assumed to be a good predictor of equity return. The asset beta used for the outdoor shop is a representative beta for the similar companies. So if you are using the proxy company data, then you will always take the assumption that proxy represent your business truly. Asset beta used to calculate the revised cost of equity is a weighted average of the asset betas of the two business. The weighting used in the non-current asset in each business, which is assumed to approximate the size of the business. So this is also an assumption that you have used the proportions by assuming that your non-current asset size representing the size of the business. That is an assumption. Share price and the price of the bonds are assumed to remain changed. Obviously, this is also an assumption. I have already discussed that you should write these assumptions. Then you have to write the reaction of equity holder. The number one reaction of the equity holder is your previous business was earning 16% on the assets. Your new business is earning only 10% return on the assets. So your new business is generating lower return compared to the previous business. And plus your new business is creating more increase in financial risk. So what is the benefit for the equity holder? Cost of equity is increasing, WACC is increasing, financial risk is increasing. And although return is increasing, but that return is increasing on the expense of higher cost of capital, higher cost of equity, and higher risk. So maybe possible shareholder may reject this because company risk is increasing. Then you will write the comments on the bondholders, and then you will write the conclusion. Bondholders are likely to be most concerned about the Kingdom company ability to meet its interest and repayment commitment. Obviously, your company has taken a previous loan, then your company is taking more loan. So the bondholders will have a concern that how this company is going to repay the interest and principal amount. And holders of the new bond are particularly likely to be concerned about the ability to repay the capital given the commitment to repay existing bondholders. So you have to write the likely reactions of the bondholders. What are the possible reactions of the bondholder, that how company is going to repay the interest and principal amount. Please read this conclusion. Please read the conclusion. Okay, what about company being attractive or unattractive? FH, if company has taken so much loan, that means company will become unattractive now. Okay. And plus, attractive and unattractive has been discussed in the first part as well. If company is selling individual gardens, company will become unattractive. Any question, guys? So it's a request, please read the question carefully. Although I have discussed part A, the report part and the last part, but if you read the examiner solution, it will increase your vocabulary, it will increase your written expression in next theoretical answers. Thank you so much for the kind words. Jawad is asking, sir, it is 11:28 now. Please move to the next question. Jawad, today our agenda was to solve only one question. Come on. Please take care of yourself. In tomorrow lecture, we will cover the next question. And please, it's a request before leaving, please solve these questions. It will enhance your knowledge. Please solve question name is Murada. Isa company. Koiden company. And you can also solve question tool tuck for the bond valuation. And Kunejoko. These first three parts are linked to the WACC. This part is bond valuation. And this part is of restructuring, but there is a part of bond valuation as well. Thank you so much, guys. Take care. Allah Hafiz. Bye bye.